Thanks for being with us here on Business Weekend. Well, the financial markets and especially the stock market right now are full of volatility and seriously some very big swings. But underlying the risks of higher inflation and interest rates are companies that will increase their profits in this new economic era. Then there's a new government and a treasurer who's already laid on the line the risks of an overheating economy. So let's bring in here two of Australia's most respected investment managers, Matt Sherwood, who is the head of investment strategy at Perpetual, and Roger Montgomery, the founder of Montgomery Investment Management. Many thanks for your time. This is a really significant issue right now. Matt, I want to start with you. The treasurer comes in. First thing he does first day, basically says, hey, things are pretty tough. Lots of chief executives have done that on their first day. In other words, let's have a profit write down, tell everybody how tough it is. If things go bad, it's somebody else's fault. If things go well, it's their responsibility. Is that what you sense that Jim Chalmers has done?
Yeah, I think he's trying to clean the decks and say that there's a lot of stress coming. There is pressure on household incomes, and not in terms of wages growth, which is already low, but what it can buy. And he wants to kind of raise his hands and say, we'll do what we can, but I've inherited this, I didn't create it.
OK, so let's go now to Jim Chalmers this week. Literally one of the very first things he does as the Treasurer of Australia is lays it on the line like this.
We are inheriting a very serious set of economic and budget challenges. And there's no use mincing words about that or tiptoeing around the serious nature of the economic challenges that the new Albanese Labor government is inheriting from our predecessors.
OK, so Roger, that's Jim Chalmers there, right? Yeah. Laying it on the line.
Yeah, but we're not inheriting it from the rest of the world.
No.
It's just from the coalition.
OK,
yeah,
so, but that thing being the case, the Financial Times this week talked about a narrow path. And I spoke earlier in the program to Adam Crichton about this, a narrow path that they're treading along to try and avoid falling into recession while trying to raise interest rates to quell the inflation. It's taking off not just in the UK and the US, but right around the world, including here.
Yeah.
So how slippery is that path?
Well, look, back in April, Jerome Powell from the US Federal Reserve, he gave a really important speech, I thought, to the National Association of Business Economists. And what he said was, look, the chances of a soft landing, we're quite hopeful of a soft landing, because if you look at, I can cite three, or he could cite 3 times where rates were increased rapidly in the US, and it didn't end with a recession. Now, what he didn't say was, out of the last 8, there were only 3 that didn't end in a recession. The other 5 all ended in recession or caused a recession. And so it's really important to understand that you've got consumers who are faced with rising prices for energy and food. If you look at the commodity complex, the prices are through the roof, from everything from wheat and rice to soybeans and cocoa and coffee.
And building materials and cars and computer chips and energy.
So all of those things act like a tax on people's consumption. And then you've got petrol prices act like a tax. Higher interest rates acts like a tax. So it's very, very difficult to raise interest rates to quell inflation without inspiring a recession. Now, all the estimates are for lower rates of growth in 23 than 22. In the United States, we're back down to about 1.6% now from about 2.2%. But we don't know where it goes from there. Does it stop there, or does it keep going?
So, OK, so Matt, where does it go from there? And what does that say about our stock market right now and the state of the health of Australia's companies?
Look, to be honest with you, Ross, given that how high inflation is, how low unemployment is, and how late these central banks are, I would argue they are really not in a world of good choices anymore. The Fed has almost got to say what's the least bad mistake we want to be remembered for this cycle, and that is getting inflation to 2% by causing a recession and having the shortest business cycle in 42 years, or go a little bit easy inflation and hope for the best, and then risk inflation becoming unanchored for the first time in 41 years.
And that's a danger as well, because eventually that higher inflation leads to higher unemployment. And given even here in Australia, half of the taxes collected by the government are from PAYG taxpayers. So there is a danger that if you start to have unemployment rising as a result of that rising inflation, it has a bigger knock-on effect on house prices, on people's ability to pay a loan.
House prices are the other thing. So you've got all these taxes on people through higher prices, and their wealth is lower because house prices are falling. So they're being hit They're being hit in terms of their wallet and how far their money goes, and they're not feeling as wealthy anymore. It's very, very difficult to see how we don't get a very serious slowdown. I'm not convinced I can accurately predict a recession, but the slowdown will be quite severe.